Well, there have been some major deals announced, excuse me, in private credit this week, or last week at least. Apollo and Citibank entering a $25 billion joint venture for direct lending. Let's get across some of the detail. Frank Denali joining us now from MA Financial. Great to see you. In fact, I gather you've just jumped off the plane.
Yeah, I'm just back. A little bit jet lagged, but
you've been at the epicenter of this action then.
Yes, I have.
What have you seen?
It's been interesting over there. Yeah, look, I mean, the co-lending transaction that was announced between Apollo and Citi is clearly a major transaction, $25 billion. Basically what's happening is that there's a private credit manager who's going to work with a major banking institution to lend into the same asset classes together. Now, I think this concept of co-lending really is the next evolution of what happens in private credit. And what it demonstrates really is that banks and asset managers, they're actually not foes. You hear a lot in the press about banks competing with private credit for deals or private credit taking share away from banks, but that's not really the thematic. The thematic is that banks are really good at some things, deposits, transactional banking, those kind of things, really vanilla loans like home loans. They have these really good networks. And then there's asset managers who are good at some things. They're good at raising capital, managing capital perhaps at a longer duration than deposits, and evaluating credit. And these two groups can actually work together in quite a symbiotic way to deploy capital out there in the market. That's started to happen globally. As I said, I think we're at the very early days, and this is a real structural evolution as to where the market will go. But it's also going to come here into Australia as well.
All right, so that potential tie-up then, how would that look here? And I'm going to give you a much smaller market, of course. But what is the potential then?
Look, we've done one of these in Australia, bringing that same technology from the US into the Oz market. It's $1 billion transaction we did with Flexi Commercial, which is a subsidiary of Humm Group, a listed company. Now, what's happening there is that they're not a bank, they're a non-bank lender, but they're really good in equipment finance for businesses, for SME businesses in Australia. We are an asset manager seeking to have access to that space, and we've partnered with them where there's a portion of the loans that they originate that we can access, we can finance ourselves, and actually we're doing that in partnership with a global bank to provide that $1 billion of what's called forward flow capital for those loans. Now that's been done now for the first time between an asset manager and a non-bank lender, but there really is the opportunity for this to be used more broadly, including with banks. So if there are areas where it's not efficient for banks to lend anymore, maybe because of the way that APRA treats certain types of loans or prudential capital, or just because they're trying to streamline their activities, they can actually partner with other firms in the market and provide that same kind of capital. And they do the things they're good at. They can provide transactional banking to those clients, merchant services, credit cards, FX, whatever.
Now, I gather also, just in terms of that opportunity there's access for investors to get involved via an ETF. How does that work?
Well, this has started to happen in the US. It's a really interesting development, which is in the US, they're now bringing ETF products that provide access to private credit and to provide access to what were otherwise unlisted funds. It's an easier way for people to get in and out of those products, I guess. I'm not sure whether we're going to see that same kind of thing happen here, or at least it'll be quite a way off. But there's the listed investment trust market in Australia, which I think is seeing a lot of development, and with the change to hybrid rules, that's likely to be an area where investors can access these kind of products today, but also some of the newer products that will come to market in the future. And it enables an investor to go on the exchange and to participate in that type of private lending, private debt, and add it to their portfolio.
Now, I also see you say that there's the rise of asset-based finance. What is that? Because you're pointing to the fact that Blackstone saying this could be a $30 trillion market. Yep. All right, you better explain that.
Yeah, that's a large number. Now, there's different people have put out different figures, but they're huge either way you look at them. Some people have said it's about 8 or 10 trillion. Blackstone, they say it's $30 trillion. I mean, that's a big market. But basically, what is this? So asset-based finance means funding whole portfolios of loans. So rather than me as an asset manager just going and lending to one company, you actually go and say, all right, let's finance a whole portfolio of these loans. And let's do it on certain terms. And you work with an originator, a non-bank lender, a finance company, or even a bank to provide that capital. Now, why this is such a big market is that it's not niche. This is not providing finance for a private equity buyout only, or providing some sort of very bespoke, very niche capital. It's actually just real world economy financing. It's financing home loans, car loans, business loans, equipment for the studio here, for businesses that they need when they need to access finance. And the opportunity for investors, for people, your viewers, and the opportunity for asset managers is to find ways to secure those pools of loans, to put them in a structure where people can add it to their portfolio. And basically, you're doing what banks did, but you're doing it in a new way.
But many more moving parts. If it's like, so large there, what are the risks?
Well, the key thing in asset-based finance is you need to have a really diversified pool of assets. You want to make sure that there's really good collateral, so security in all these loans. If it's a home loan, it's secured by a property. If it's a car loan, it's secured by a car. And you want to make sure the borrowers themselves are high quality, that they can actually pay back those loans over time, just the way that a bank would think about it. And that's why you need to have all the parts of the ecosystem working together. You need to have the finance company going out there, sourcing the loans, underwriting them, following their lending procedures. You need to have people that are good at sourcing capital, like asset managers and banks, bringing that to the table for those finance companies to do what they do. And then ultimately you need investors to participate in this ecosystem and to add this kind of debt to their portfolio, really as an alternative to what they got in fixed income in say bonds. Because when you buy a bond, especially in Australia, almost all our bonds are bank bonds, all you're doing is giving capital to the bank to do the same thing.
Yep.
This is really just getting more direct participation in that and probably a higher return.